If I told you that there was a way to save 40 grand for your first home tax-free and get a fat tax refund while you're at it, you'd probably say, "Oh, all right, well, what's the catch here?" Well, this time there isn't one. It's called the First Home Savings Account. And no, this isn't a clever trap set for you by the CRA, unless they're brainwashing me. If you're planning to buy your first home in Hamilton or Canada for that matter, then this is one of the smartest tools that you're probably not using. In this video, I'm going to break down what it is, how it works, and how to use it. My name is Steve Lopresti. I'm a real estate agent in Hamilton, Ontario. So if you have any questions at all about how to utilize the First Home Savings Account to buy your first home, you can send me an email or reach out to me. My contact info is in the description. The First Home Savings Account, or the FHSA, is basically a cross between an RRSP and a TFSA, but it's specifically geared towards helping first-time buyers. You can contribute $8,000 a year up to a lifetime maximum of $40,000. Now that contribution is tax deductible, which means that it reduces your total amount of taxable income for that year. Very similar to how an RRSP works. So if you put in $8,000 for this year, the government treats it as if you earned $8,000 less than you normally would have, and that results in a tax refund. So far, so good, but here's where it gets really interesting. Once it's in the account, you're gonna wanna grow that money through investments, and as it grows tax-free. When you finally withdraw the funds to buy your first home, you don't pay any tax on that amount. Any gains that you made during that period, any capital gains, there's no capital gains tax, no income tax, nothing, which is very similar to the TFSA. So you're basically getting the best of both worlds. You get the tax deductions when you put the money in, and you don't pay tax penalties on it when you take the money out. It's like stuffing your face at a buffet and having somebody else pay the bill. Now, I know we all love paying taxes. Like, nobody loves paying taxes more than I do, but they can really get in the way of your long-term plans when you're trying to buy a home just by eating away at your savings and really extending your time frames longer than they need to be. Taking advantage of a program like this can help speed up your savings rate so that you can get into your first home a lot sooner. But there are some rules around this account that you need to be aware of. I know, there's always a but. But if you don't use this thing the right way, you're going to lose those benefits and you could get hit with some taxes that you weren't expecting. To open an FHSA, there's a few requirements. The first is that you need to be 18 years old. So you can't open one for your 3-year-old. He's just going to have to start a lemonade stand to save up for his first home. You need to be a Canadian resident, and the most important part is that you need to be a first-time buyer. Now, it's called the First Home Savings Account, so that's a little obvious. And before you go, yeah, I know, I'm a first-time buyer, you want to make sure that you actually fit how the CRA defines a first-time buyer. You can't have lived in a home that you owned or jointly owned with somebody else at any point in the last year or the previous 4 calendar years. So if, for example, you inherited your grandmother's condo back in 2021 and you lived in it for just a short period of time, technically that counts as having lived in it and you are disqualified as a first-time buyer under the CRA's definition. Now, on the other hand, if you did inherit something but you never lived in it, then you're still good. And also, interestingly enough, if you bought something more than 5 years ago and then you sold it and let's say you rented during that period or did something else, but you didn't live in a home that you owned during that time, you technically are a first-time buyer again. Kind of weird. And if you bought a rental property during that time, but you didn't actually live in it and you lived somewhere else in another rental that wasn't owned by you, then that still counts too. You're still a first-time buyer. Now, when you are buying the house, it has to count as a qualifying purchase. Now, what does that mean? It means that the home has to actually be in Canada. You can't use the money to buy a shack on the beach in Costa Rica. You have to intend to live in it. This can't be an investment or a flip project. It has to be your principal residence. You need to have a signed agreement to buy the home before October 1st of the following year after you withdraw the funds. And then you have to occupy it within 1 year. So you have about 12 months after you purchase the house to actually move into it. Now, an important thing to note with the FHSA is that once you take the money out, you cannot put it back in. You want to make sure that when you're taking it out, you're actually ready to use it. Now, another way that you can take advantage of this account and really skyrocket your wealth building over the next several years is by combining it with house hacking. You can use your FHSA funds to buy a duplex or some type of multifamily property. You can live in one of the units and rent out the other ones. It's still technically covered under that umbrella because you're living in it. Even though you're collecting rental income, because it's your primary residence, it still counts. So you can use the FHSA to save up faster for that home, and then you can house hack in order to help with your day-to-day affordability. And theoretically, you could also pool your funds with other buyers. Let's say you buy a triplex with 2 other friends and you're going to each live in one of the units. You can each have your own separate FHSAs that you use to fund this purchase. Now, one thing to note is that you'd each have to qualify separately as first-time buyers, and you'd each have to live at the property and make it your primary residence. Now, at this point, you might be wondering, how long do I actually have to live in this house? Like, am I just stuck here forever and am I never allowed to move? Well, no, not quite. There's no exact length of time written into the law that you have to live in the house, but the CRA just expects you to genuinely intend to live there as your principal residence. That means that you can't just crash there for a weekend and call it a day. At least a year is a safe rule of thumb for a good length of time. So you want to move in, change your ID, change your bills to go there. You want, if you ever get audited by the CRA, you want it that you have a paper trail for them to follow. If not, and you're unable to prove that you lived there during that period, then they can retroactively tax you for that FHSA withdrawal, and that's going to be a pretty hefty bill. And I definitely don't recommend you try to lie either about this. Say that you're going to move into the house and then don't use it as a rental or something. Bottom line, if you use this account the way it's meant to be used with no funny business, then you'll be fine. Now, if you're finding this helpful and you're actually serious about buying your first place in the next year or two, I put together a free first-time buyer guide. The link is down in the description. It breaks down the entire process around buying a home for you, how to prepare and what mistakes to avoid, so go check out the description if you're interested. All right, now that you know how the FHSA works, here's how to actually use it. The first step is the obvious one, is to actually open the account. You can do this at most banks, or most brokerage accounts will allow you to do this as well. Just like with a TFSA or an RRSP, it's a fairly simple, straightforward process. It takes anywhere from 15 to 30 minutes. Now, you want to make sure that it actually allows you to invest and not just park your cash in a boring savings account earning pennies. Step 2 is to contribute strategically to the account. You can contribute $8,000 per year up to $40,000, and that's starting from when you opened the account. Now, if you don't hit the full $8,000 in 1 year, that amount rolls over to the next. So let's say this year you only put in $5,000. Next year you can put in $11,000. And remember, like I mentioned before, if you take that money out, it's a one and done deal. You can't put it back in. You lose that contribution room. Now, a little bonus tip for you. You can use your tax refund from this year's contribution to fund next year's contribution. And now we're cooking with some compound interest. Step 3 is to invest it, because this account is built for growth. Whether you like index funds, ETFs, mutual funds, whatever, just put it into something and invest based on your risk profile, your time horizons, and so on. And then step 4 is to use it for a qualifying purchase when you're ready to buy. And then that's it. Now, I recommend working with a registered financial planner or tax advisor before setting all this up, just to make sure that you're not running into any potential landmines. And if you want to make sure that you're setting yourself up properly to succeed when buying your first home, use the link in the description to book a free call with me, and we'll walk through your entire timeline, your budget, and we'll come up with a plan that works for you. And don't forget to grab a free copy of my first-time home buyer survival guide. It just walks you through the entire process. You know exactly what to expect the entire time. All right, click this little button right here with my face in it. I'm going to guess it's right there. Right there. Click the button, subscribe to the channel. Press this one over here if you want to watch some other mediocre content, I'll be honest. No, I'm just kidding. But yeah, click this one here if you want to watch some other Hamilton real estate content. And then, yeah, thank you so much for watching. I'll see you in the next one.